Hey everyone, I'm Cody Charnell. I'm a multifamily real estate broker here in Long Beach, and we have some big news. The Federal Reserve finally just announced their first rate cut after a couple years of this tightening cycle. And to celebrate that, I've brought in David Guevara. David is a lender. He specializes in loans for five-unit apartment buildings. So, David, thanks for being here.
Yeah, of course. Thanks for having me.
So David, I mean, this is big news. The Fed in their August meeting announced that it was time for rate cuts. They just had their meeting yesterday, so their September meeting, and they announced a bigger rate cut than we were expecting. I think most people were anticipating 25 basis points. They ended up doing a 50 basis point cut. Can you tell us what's going on in the loan world and how this is affecting loans for people who are looking at the 5 unit and up buildings?
Yeah. I'll start off by just giving the disclaimer that I only do loans for 5 or more unit properties for apartments, so I can't really speak to the normal 30-year fixed 1 to 4 unit space. But on the 5+ unit space, rates actually have been dropping slowly over the last couple of months, and we actually got a pretty big drop last week, or in the last couple of weeks, where lenders were starting going from that 6.25 to 6% down to like the mid fives, high fives, and then now we're in the mid fives. And that's only happened over the last 2, 3 weeks. So, um, as far as the Fed meeting goes, it was a larger rate cut than I expected. I thought we were going for a quarter point cut, but it ended up being a half point. Oddly enough, though, the Treasury rates actually increased yesterday, and they're increased a little bit more today as well. So, I, from what I was reading, I guess Wall Street's kind of looking at it as the fears of recession are kind of calming down, and so that's why the the Treasury rates went the other way. But but it's definitely a step in the right direction. It's definitely indicative that the Fed is aggressively going to be wanting to lower rates over the next couple of years.
Yeah, it's exciting news for people who've been sitting on the sidelines, kind of waiting for this. And you mentioned a couple interesting things there. So, a lot of people have been sitting on the sidelines, kind of waiting for the Fed meeting to happen so they can definitively know the Fed is cutting, right?
Yeah.
But the treasuries, which are what kind of dictate interest rates, have been declining leading up to the meeting. So, for people who may not track treasuries, may not pay attention to interest rates day by day, can you tell us kind of how uh, banks are pricing their interest rates and, when these changes happen and why the changes happen?
Yeah, so I guess I'll go back for a long time, the Fed would make a decision and then the market would react. And that's not really how it works anymore. It seems more like the Fed kind of telegraphs the way that they're going to go, or the way a few options that they're thinking of. The market will kind of make their guess on what the Fed is going to do, or kind of react preemptively to the Fed, and then the Fed makes their policy change. And so that's kind of what we saw. We saw the interest rates drop over the last few weeks or the last month, kind of anticipating that the Fed was going to lower their rate. And then the Fed actually lowered their rate. As far as how banks calculate their rates, a lot of times, like on the agency side, Fannie Mae, Freddie Mac, they're looking at the treasuries and they're looking at their own pipeline and how much production they want to do, as well as the other lenders, which are mostly small banks, regional banks, credit unions. And they're determining what is what do we need to do to be competitive, and how much do we want to lend, and where do we need to price ourselves in order to lend that amount. And so what banks do is they look at the treasuries to kind of determine where they should be. They look at other banks as well, they look at their own pipelines, but they also have an internal cost of funds that they have to be aware of. And so what we're running into on some lenders right now is they're saying, hey, it's great that treasuries have dropped and it's great that the Fed is lowering their rate, but we're paying 5% for our deposits in high yield savings accounts. And
Mm.
so if we're lending money out at 5.5%, we're paying out 5%. That's not a big enough spread to keep the lights on. And so I think what we're going to see is still rates are going to decline. I just think that it's going to take a little bit longer than consumers are hoping for, because banks have to restructure how they handle their deposits and how much they're paying out. They need to lower their internal cost of funds.
Interesting. Um, so going back to the treasuries, so on like a 30-year fixed mortgage, most people will track like a 10-year treasury as an indication of where rates might end up or what rates will be. And so you have, the 10-year treasury, which is a government backed bond basically,
Hmm.
and lenders will add like a risk premium on top of that. So when you're in the commercial space, it sounds like there's some additional elements that are considered. What treasury are we talking? The 5-year treasury in most cases that they use as a benchmark, or is there some index that people want to pay attention to?
It all depends. It changes from lender to lender. So a lot of the lenders we work with will base their rates. They'll say, like, one of the lenders we work with will base their rate on a 3-year fixed, or sorry, a 3-year treasury, and then they'll just do increases for their 5-year, 7-year, and 10-year. So they base everything off the 3-year and then go from there. Other lenders will say, if you want a 3-year, we're going to have this spread over the 3-year treasury. If you want a 5-year, we're going to have this spread over the 5-year treasury, and so on. And other lenders will just look at the 10-year treasury and then make an internal call. And sometimes they don't base it off of a direct spread based on the treasuries. They'll kind of track the direction they're moving in and then how that relates to their internal cost of funds and then price based off of that.
Okay, interesting. And then you also mentioned that in the 5 unit and up world, when we're talking about where the funds are coming from, you mentioned agencies and then you mentioned a lot of small regional banks. So are those the main two places that people are shopping for loans?
Yeah, in the space we're talking about, which is that like 5 to 50 or 5 to 75 unit buildings, that's absolutely true. When you start getting into larger stuff, then you start to see life insurance companies, you start to see debt funds, you start to see, um, you know, uh, FHA loans, stuff like that. So
Mm.
those are for the much larger properties. I don't work in that space that much. I generally stay in that 1 to 20 million dollar space in loan amount. And so for those, you're generally seeing Fannie Mae, Freddie Mac, you're seeing regional banks, local banks, and you're seeing credit unions.
Gotcha. Okay, good to know. Yeah, I think, when I was first starting out in the business and trying to understand why there was this difference, that's something I didn't realize. So maybe some people listening, that'll help them kind of understand what happens in the 5 unit and up space. One other thing I wanted to ask you about was leverage. So as interest rates went up over the last couple of years, um, you know, it took a lot more money to buy a 5 unit and up building because you had to hit a certain debt coverage ratio that the lender was looking for, right? So
Right.
they make you put enough down so that the building is going to cash flow from day one. Can you kind of walk us through like the typical down payment amount that you're seeing today and if it's changed over the last year?
Yeah, it's certainly changed. I would say it's gone up over the last year. Right now, we're seeing a lot of deals that are trading at high fives to low six cap rates. And generally, those deals can get a 65% loan to value. So you're talking 35% down. Sometimes even a little bit more, sometimes a little bit less, but right around that 65% loan to value range with new interest rates as of like the last couple of weeks. Before
Hmm.
that, when rates were 6%, you were looking at more like 60% loan to value. Um, but that's up big time from a year ago because a year ago the market hadn't adjusted down quite as much. So you were seeing more buildings sell in the high five cap rates instead of the low sixes or the mid fives for the higher cash flow stuff that we see in Long Beach a lot. And
Hmm.
then um, you were also seeing interest rates in the 6.5, maybe even a little bit higher than that. And so when that was going on, I mean, people were happy if they could put down if they could get a 55% loan or a 50% loan and only have to put down, you know, 45 or 50%.
Yeah, yeah, and that was a tough time, and I think coming off of like the post-pandemic years when rates were super low, a lot of people were in that space, and their loans were starting, like the fixed period was expiring, so they were starting to adjust, and they were looking at refinances, and they bought with, let's say, 25% down, and now in order to refinance and get a new fixed rate loan, it was they were going to have to actually put money in, so like a cash in refinance.
Yeah.
um, can you talk to us a little bit about like what's happening with people whose loans are adjusting. There was a saying that people were throwing around for a long time there called, and they were saying stay alive till 2025. Is that still the case, or is there enough breathing room now with rates coming down that you think most people are going to be okay? Or
So it depends on the deal when you originally got your loan. If you got your loan in 2021 and you got a 3% rate and there was no upside, you'd fully maxed it out.
Mhm.
There's no ADU to build or anything like that. You're still probably not going to be able to get the same rate, or sorry, the same loan amount with rates as high as they've gone. But most properties weren't like that. Most properties had 20% upside in rents or experienced some rent growth after that, that even though it's kind of flattened out now or grown at a slower pace, you still had the benefit of some higher rents than what you originally underwrote. Um, People that built ADUs, stuff like that. So if you've been able to get your income up, chances are at around the 5 to 5.5% range, you're probably going to be able to get your loan refinanced. Everything's case by case, but for the most part, I don't think it's going to cause a huge issue in the market. But there's certainly going to be some people, and there already are some people that can't refinance at the same loan amount that they got in 2020 or 2021.
Yeah. Okay. And so for those people, if they can't refinance, their rate just adjusts, right? And are most people just kind of holding on at the higher interest rate, letting it float, or are you seeing people sell, or what's kind of the norm right now?
So the rates that have adjusted, or the loans that have adjusted, the interest rate is much higher than what you could get on a fixed loan today. So at least of the people I work with, there aren't a lot of people letting their loans just float. Um, Unless the original loan had a cap on how much it can increase per year. Not all the lenders, in fact, very few have caps on how much it can increase on the first year. Almost all the loans have caps on how much they can increase each year, but they'll have an exception for the first year, so it can usually bump up to market.
Oh, I see.
But a couple of the lenders said it can only increase 1% per year. So if you locked it in at 3% and it went adjustable in 2023, then it's now at 4%, and then it can go to 5%. So you're still better off just
Hmm.
holding it while it's quote unquote adjustable, even though it's capped on how much it can go up. Um, but for everybody else, it hasn't made sense that when the loans that are actually adjustable every 6 months or every 90 days or whatever, it hasn't made sense to keep them. So a lot of what we're doing these days is we're locking them into a shorter term fixed period, or like a 3-year fixed or something like that, or like a 5-year fixed, but with a reduced prepay or no prepayment penalty. And that's just because most of the clients we work with see that rates are going to be dropping in the next couple of years. Values are probably going to be increasing along with that in the next couple of years, and they're going to want to access more equity or just get the benefit of a lower rate and refinance in a couple of years. So we're trying to make it or I guess as non-burdensome as possible in the next few years to be able to get your money out, or just lock in a better rate.
Okay. Yeah, I think that sounds like a good strategy. And so are these people having to do cash in refinances, or are they usually at a point where they're just doing like a rate and term refinance and, hoping they can refinance again in the near future?
I've done a couple of cash in refinances recently, but most of them are just we're right there. If their cash in is like, maybe 10 grand and then they have to pay for closing costs or something like that. But you're not seeing what could have been, which was like 400, $500,000 loan pay downs, even more than that sometimes. And
Right.
so luckily we haven't had any of that yet. Most of the loans we did in the last time everybody refinanced was basically 2021, or I guess late 2020 to early 2022.
Hmm.
And most of those loans were 5 or 7 year fixed loans. So
Oh, good.
those haven't rolled over yet. There were just some that we did that were, clients were adding ADUs and they wanted the ability to access their capital faster, or they bought with bridge money or something like that, and they wanted to be able to refinance. So those are the ones that we're dealing with now. But for the most part, everybody, or the bulk of our clients, are good for another couple of years.
Oh, that's good news. So, yeah, probably not a ton of distress in from those people anyway. It seems like pricing has dropped pretty significantly in the 5 unit and up space. We were looking over numbers and we were estimating somewhere between 20 and 25% for Long Beach if you're in that 5 unit and up space.
Hmm.
And the price drop is largely just driven by interest rates going up. So the thought is as rates continue to go down, we'll probably see that swing the other direction. Is that what you're thinking as well?
Yeah, yeah, it makes sense.
Hmm.
Um, I mean, nothing really. Rents haven't declined. I would say, if anything, they've flattened out, and we're not seeing much rent growth, or haven't over the last year. But the real driving factor of cap rates increasing and GRMs dropping is has just been interest rate related. And so as you start to scale that back and interest rates come back into a normal territory, um, it only makes sense that prices should rise.
Yeah. Yeah. I'm thinking the same thing. Um, so I guess let's talk about predictions. And I know it's really difficult to predict what's going to happen with rates, but do you see, or what do you see happening over the course of the next year in the commercial space? If you're brave enough to give a prediction, we won't hold you to it.
This isn't being recorded, right? Yeah.
Yeah.
Um, I would say that we're going to see two things. I think the Fed is going to continue to lower interest rates, but I don't think it's going to be quite as quick as everyone's hoping for, or quite as aggressively as everyone's hoping for. I think we'll see maybe another decrease this year of a quarter, and then maybe a few quarter point decreases next year. But it's all so data driven that none of that's reliable. We can't expect a certain amount of cuts. A couple of bad inflation reports, and we're back in bad territory.
Mhm.
So I think that's most likely what's going to happen, is just a few cuts, but not anywhere as aggressively as a lot of people are thinking, where every meeting for the next year they're going to cut 25 basis points. Um, but I think something that a lot of people are not seeing is that bank rates are based off of whatever index or whatever cost of funds or whatever they have, plus a spread. And what we were seeing in 2018, 2019, 2020, 2021 was bank spreads were around 150 basis points over the 10-year treasury, the 5-year treasury, or 3-year treasury, whatever they were looking at.
Okay.
And right now we're seeing,
So sorry.
yeah,
Let me just clarify. So if the 10-year treasury was at 1.5%, you're saying that the bank would add another 1.5% on top of that, and so the interest rate that they offer would be about 3.
yeah,
Okay.
exactly. So not based off of the Fed funds rate, obviously, because that was zero, and none of the banks were going to chase the interest rates all the way down to zero.
Hmm.
But they were kind of looking at the swaps or the treasury rates or whatever it was. And so if the treasury, yeah, was 1.5, then they would have a 1.5 spread and get a 3%, and you'd see a 3% rate.
Hmm.
Right now, because the banks are trying to protect themselves, because they don't have as much money to lend, and because they're not trying to do as much volume, they've increased their spreads dramatically. And so now on a lot of deals, we're seeing a 220 spread, a 210 spread, a 200 spread. And so as interest rates come down, banks pipelines or and rates start to, or sorry, and loans start to roll over into adjustable. Banks are going to get a lot of their money back, or they're going to be able to sell off their portfolio without losing money, because the difference in interest rates from where they're at and where they could sell them is going to be lower. So they can
Hmm.
sell them off. So they're going to get a lot more liquidity, and I think they're going to become a lot more aggressive in their lending. And when that happens, I think we'll see spreads start to come down again. And so if the 10-year treasury, it doesn't have to go to 2% for us to see a 4% rate. It can go down to 3% or 2.5% or whatever, in order for us to see a 4% rate, which I still think 4% rates are far away. I don't I don't want to get anybody's hopes up, but I think that in addition to the Fed coming down, banks are also going to get more aggressive.
Okay. So based on what you said earlier, most people refinanced between like 2020 and 2022
Yeah.
with like 5-year fixed money.
Mhm.
So you're thinking between 2025, 2027, the banks are going to get paid back for a lot of those loans as
Yeah.
people refinance. They're going to have more money to lend out, and probably coinciding with that, the Fed funds rate will have come down. Treasuries probably would follow, and we're going to see a really aggressive lending space probably sometime between 2025, 2027.
Yeah, yeah. I don't think it'll be more aggressive than what we saw in 2021. In fact, I think it'll probably still be a little bit less. That was like,
Mm-hmm.
it was basically free money at that point, so they could get as skinny as they wanted to. I don't think we'll see it get that tight, but it'll probably come down a little bit from the 220, 210 spreads that we're seeing right now.
Got it. And what about if we were to go into a recession? The Fed's main tool to fight that and keep the labor market in check is to cut rates. Do you think an aggressive rate cut during a recession, like the bond rates would still come down, or the treasuries would still come down?
Yeah, I mean, the treasuries, at least lately, have been kind of tracking wherever they think the Fed is going to go. So if they think the Fed's going to lower their interest rate, the treasuries have been dropping. So I guess it stands to reason that it's been so funky over the last 5 years where we've had inverted yield curves and stuff like that. But if it keeps behaving like it's been behaving, then expecting the Fed to lower rates should lower treasury yields.
Got it. Actually, I just thought of something. So you were talking about the book value of loans. So a lot of these banks, they lent out money at 3.5%, and then interest rates went up. And what banks will sometimes do to get liquidity is they'll sell their loans on like the secondary market. But no one
Yeah.
wanted to buy a loan that was returning 3%, right? So if a bank wanted to sell that, they'd have to dramatically cut the price and they would actually lose money selling a package of loans, right?
Yeah.
And so there was a point in time where there were a bunch of small regional banks on, I think, the FDIC watch list
Hmm.
because they were, you know, um, they didn't have the liquidity requirement, or like the book value of their loans was like super negative. Are we still at a point where there's regional banks at risk of failing, or what have you heard on that topic as rates have come down recently?
So the last I heard or looked into that was a few months ago, and obviously the market's changed and interest rate outlook has changed in the last few months. So I don't want to speak to anything that's like super, super recent, but I do think that that has a lot of, or that's giving the Fed a lot of pressure. Because the last I heard, there was like 60 something banks that had unrealized losses that were large enough to take them out.
Wow.
And that's obviously something you can't have,
Hmm.
and keep the economy in a good position. So I think part of the focus of the Fed is to make sure that those office building owners and retail space owners and multifamily owners and everybody is able to refinance without needing so much capital, paying down their loan, to the point where they just say, you know what, it's better for me to walk away and I'm just going to put it on the banks.
Yeah, yeah, and then if that were to happen, it sort of spirals out of control pretty quickly.
Yeah, and I don't think they want that. I
Yeah,
don't think any of us want that. So, um, yeah, that's definitely got to be giving the Fed some downward pressure.
got it. Okay, good news. Um, and remind me, where are commercial interest rates at today?
So for call it a standard, $2.5 million loan on a multifamily property, you're looking at a rate of 5.5%. I would say average. There's some lenders as low as 5.2, 5.25, and there's some lenders that are up in the closer to 6%. And all that, the difference just depends on how they underwrite, and
Like
pre
LTVs and
yeah,
okay,
prepayment penalties, interest only. Obviously, everybody wants the lowest rate, but sometimes you're willing to take a little bit higher of a rate if you're getting better terms in a different department.
makes sense. Well, David, this has been awesome. For anyone listening who's interested in either doing a purchase or a refinance on a 5 unit and up apartment building, David's a great resource. He's one of the partners at Momenta Capital Group, so be sure to reach out to him. And then if you're interested in buying or selling a multifamily property here in Southern California, feel free to reach out to me. That's what I specialize in. And yeah, David, thank you again. And
Yeah,
until next time.
of course. Thanks for having me.
Awesome. Thanks, everyone.